All right. Today is Monday, the 9th of May. And this is a recap for the stock market activities today. Folks, I got a good one for you tonight, and apologies for the absence over the weekend, but I made it up for you with the video that I released earlier. Lots of earnings, lots of charts. So don't miss on that. But guess what? I got even more charts for you. Tell me again which YouTuber out there bombards your face every single day with tickers, nonstop. So stick around for the charts analysis. I got more charts for you, a lot of them. And with that being said, let's dive right into it. In focus tonight. No rescue. No. The Fed is not going to bail your ass out this time around. You know why? Because the Fed put is dead. And so is Tina. So far, the month of May has been disastrous, shall we say. So perhaps the sell in May and go away was a good advice, at least until now. Perhaps the cooks of the Bureau of Labor Statistics will come out on Wednesday with a peak inflation reading and conduct the rescue, the plunger, because the market needed. Look at this. So far in the month of May, everything is down, with the exception of the US dollar and Brent crude barely in the green. Besides that, everything is down. The yen is down, treasuries down, bonds down, S&P 500 down, gold down, everything is down. And look at this, the outflows from REITs, the largest since the crash of the thing back in 2020. Unbelievable. So is the crash in the NASDAQ, by the way. We're now down about 25% from the peak. Look at these drawdowns, pretty much as close as we can get to the lows from 2020 after the crash of the thing. And it gets uglier, folks. The tech giants, the big caps, which everybody thought, well, not everybody, the morons thought they're going to be defensive. Stick with the big caps. Stick with Apple, because these names never go down. The crash is only happening in RKK and the like, so really? Tech giants lost $1 trillion in the last 3 days alone. And by the way, go back in the videos I produced in this channel. We covered legendary investor Jeremy Grantham, who explained to you in details how the crash will happen last year. You know why? Because this guy has been alive since the South Sea bubble. He has seen it all. And he said, bubbles don't crash all at once. They start with the mania stocks, the high multiple, high beta stocks, the RKKs and the likes. And then they start shooting at the mid caps, the high growth, high momentum names. And little by little, they start shooting at the leaders, the big caps. In the 90s bubble, for example, the smaller dot-com bubble names already crashed in 98, 99. The famous example is the Globe.com. And then they moved to the Yahoos and the AOLs, the Qualcomms, and little by little, they started shooting at Cisco and Microsoft. That was the end right there and then. This is no different. They shot the so-called stay-at-home stocks in the fourth quarter of 2020. That was the top right there and then. Names like DocuSign, Zoom. Now I've been shorting all of these names. And then, in the fourth quarter of last year, they started shooting at the software names. We got the peak in software. Now they're moving at the FANGs, the big caps. So this is unfolding exactly as Jeremy Grantham explained to us. And even Bill Gates, oligarch Bill Gates, criminal Bill Gates, says interest rates are likely to rise enough to cause a global economic slowdown. And he admits that the bears are right. You have billionaire investor Sam Zell, who issued a warning saying that the U.S. faces serious problems if the Fed doesn't hike rates by 100 basis points. And this is what I've been saying, Mr. Powell. The time for games is over. Stop the obsession with the stock market and do what needs to be done. If it's 75, do the 75. If it is 100 basis points, do 100 basis points. And frankly, in my opinion, he says the neutral rate for now is 2.5%. So get us to 2.5% right now, Mr. Powell. Nope, he wouldn't do that. And he took the 75 basis points out of the toolbox. Why? Big mistake. And now that stocks are diving down big, all of a sudden even the hawks are backpedaling and saying, "Oh, we didn't mean we didn't mean that we have to tighten the monetary policy by that much." Even James Bullard came out and said, "We're not behind the curve. We don't need 75 basis points." These people are obsessed with the stock market. And so long they continue to be obsessed with the stock market, they will continue to fall into landmines and make more mistakes, which, by the way, will crash the economy and the stock market. Even famed hedge fund manager David Tepper said that taking off the 75 basis points tool out of the box is unforced error. And he described what's going on as unhinged stock market. And of course, Mr. Tepper He probably watches the show, by the way. And if you do, here's one for you, Mr. Tipper. But anyways, Mr. Tipper says that we were supposed to rally in the stock market in the aftermath of the FOMC Jerome conference, whatever the hell it is, even though taking the 75 basis points out of the box was a mistake. But what caused the rally, the rebound, to reverse right away was the commentary from the Bank of England in the very next day, admitting that UK inflation will reach 10% by the end of this year. What does that mean? It means that the Fed is indeed way behind the curve. The Bank of England is way behind the curve. And of course, the insane ECB leadership, Madame Lagarde, is way behind the curve. Because if inflation is going to reach 10% in England by the end of the year, well, it's going to be over 10% here. We have a head start over the UK. The Eurozone have a head start over the UK. So what are we saying here? If inflation is going to be double digits by the end of the year, the Fed needs to act right now. We continue to say that over and over again, but the Fed remains in a coma. And the damage is so severe. Remember the so-called retail investors? Yep, all of these Wall Street bets gamblers and the likes, the Robin Hoodiots and the likes, running heads first, Naruto style, buy first, ask questions later. Well, they're holding massive bags now. The retail basket of stocks is crashing. If you thought the damage in the S&P 500 is severe, look at what's going on at retail land. And frankly speaking, they're not really retail. You know, you and I are retail. We've been trading for a long time. These guys are newbies. They got excited with the mania. The stimmies all over the place. They downloaded Robinhood. They started buying calls and stocks randomly based on somebody spinning tickers on TikTok or Reddit. That was working fine until it didn't. I said it only takes one mistake. Specifically for those options gamblers. You buy calls for the last 2 years. You score big. But the greed doesn't stop. The psychology remains the same. We all know what happened in the dot-com bubble. We all knew that this one will end the same way. Even those who denied it, even those perma bulls, they knew in their heart of hearts that this will end up badly because they keep hearing about it from the bears saying the valuations don't make sense. The stock market is going to crash. This is the dot-com bubble, yada, yada, yada. We've been saying this in 2020, 2021, and now everything is coming true. But folks, the psychology never changes. The psychology of greed, the psychology of addiction, of gambling, that never changes because everybody wants to stretch their gains and their luck to the very end. We said in this channel, this is a game of musical chairs. You're dancing on the edge of a knife against time. Jerome Powell is not going to come out and say, hey folks, party's over. Please rush to the exit. He's not going to say that. He's going to tip his buddies, the insiders and the likes. They get out and then all of a sudden you get caught with your pants down. But guess what? That time, the dance floor is already on fire. With all of that being said, guess what? The retail crowd's still buying the dip. Yep, U.S. retail investors scooped up stock during Thursday's market drop. And they continue to catch a falling knife, unfortunately. Retail investors net bought $2.6 billion worth of stocks and exchange trading funds on Thursday, according to Vanda Research. It was the highest level of net buys ever recorded by Vanda, whose data goes back to January of 2014, the company said. The top retail purchases during Thursday's sell-off, which erased the gains from a relief rally on Wednesday when the Fed raised interest rates by 0.5 percentage point, were the Spider S&P 500 ETF, the SPY, and the Invesco QQQ, and Apple. So again, even though they're buying the dip, they're being more disciplined. They're buying the ETFs and Apple, but even that's not working, at least for now. Here comes the stupidity, though. The fourth most popular retail purchase on Thursday was the ProShares Ultra Pro QQQ. This is the TQQQs, which corresponds to 3 times the daily performance of the NASDAQ, while the sixth most popular pick was the ProShares Ultra Pro QQQ Short. This is the SQQQs, which is a 3 times bet against the index. The S&P 500 index slumped 3.6% on Thursday, and it is down around 13% year to date. It's down even more considering what happened on Friday and today. And here's the problem, folks. The retail crowd, they're at the end of their journey. They wasted 2 years gambling on stocks, and now, just like the previous generation of gamblers back in the dot-com era, they will get washed out. It was a nice ride, a roller coaster ride. You saw the highs. Now you're going down to the dumps. What is the point here? You gotta stay disciplined. You gotta play the game with the rules. Otherwise, you're not going to survive in this jungle. because that's what it really is. It's predators looking for praise. Market bubbles are pretty much a transfer of wealth process. That's what it really is. The money got transferred from the poor, middle class, the American taxpayer, all the way to the 1%, the oligarchs, the rich. They all cashed out, and now they're leaving the dummies, you and I, holding the bag. And therefore, you gotta be disciplined. Yes, you can trade. You can buy calls, puts. Yes, you can trade the high mania names, the high multiple stocks that don't make sense at all. But this whole let's go to the moon mentality, diamond hands mentality, that is stupidity on mass scale. That's never been seen before. You gotta stay in the game for the long run. Have a portfolio. Follow the macro. Follow the monetary policy. And yes, you can use a portion of your portfolio in trading options. And you can go wild and crazy, but not with your entire portfolio. Look at the retail flows. They topped back at around the fourth quarter of last year, the so-called Santa rally. They got caught in an epic bull trap, and they continued to lose money over and over and over and over and over again. We're about to see negative flows from the retail crowd. That means they ran out of money. That's it. Poof. It's gone. All the stimmies, all the attendees, all the gains, poof. Gone. And I know what you're going to say. You're going to say, well, what about the Fed? The Fed is going to rescue us, right? Not anymore. The Fed works for the rich, for the oligarchs. Well, the oligarchs already cashed out last year. They're not going to bail us out now. Listen to the demon from Minneapolis, Neil Kashkari.
Is it fair to assume that you're not paying that much attention as a body to what happens to the stock market at this point? It's going to be focused on inflation, and what happens to the market happens?
Absolutely. I'll be honest with you. I never focus on the stock market as a goal. We pay attention to asset prices as it comes back around into psychology and spending behavior, but ultimately it is our dual mandate that drives us. You know, for 5
years. You just said you don't focus so much on the stock market unto itself, but you do focus on the psychological impact of the price of assets. And effectively, what I imagine you're saying is the wealth effect or the lack of a wealth effect. Given where you've seen assets move over the last month, how do you think that psychology has changed? Do you think that, and also given some of the other numbers you were just talking about in terms of how much household wealth families have, how much more does that have to come down to change the psychology?
Well, it's a good question. You know, when I think about this regime that we might be in a higher pressure equilibrium, the wealth effect is part of that. So stock prices were very high relative to pre-pandemic. Home prices very high relative to pre-pandemic.
So Neil now says, oh, our job is inflation now. We don't care about the stock market at all. Oh, really? Because back then, in the crash of the thing in 2020, when the rich and the oligarchs were ouching and they were screaming and yelling at the Fed, do something. We're losing billions here. Remember what Neil said? Here it is.
Can you characterize everything that the Fed has done this past week as essentially flooding the system with money?
Yes. Exactly.
And there's no end to your ability to do that.
There is no end to our ability to do that.
And of course, we all remember the infinite cash. Remember that one? Infinite cash. We got infinite cash to prop up the stock and real estate markets, to cover for the rich, to bail out the rich. But now that the rich is out, who gives a shit about the stock market anymore? We don't care. And while the retail crowd is buying, the big shots are saying there is more pain to come. Bank of America says the S&P 500 could fall another 28% before this historic sell-off is over. Wow. And certain VIX indicators say that there is no market bottom here. What are they talking about? Here it is. Look at the VIX curve, which we covered before in this program. If this sell-off morphs into a crash, then we have a long way to go. Look at the VIX curve. We're not even close to a bottom. We're close to a bottom when the VIX curve dives down to extreme negative readings, like we saw back in 2008, for example, like we saw back in 2020. We're not even close to that. The VIX could go much, much higher. That means a lot more pain for the equities market. And of course, the geniuses at Goldman Sachs, they get paid millions of dollars to do research. They say by the end of the year, the stock market could go up or it could go down. Wow. I didn't know that. That's news to me. And they say 4,700 is the target if we have a rebound, meaning if the equities market finishes up higher from this point on, which also means we're not going to recover all-time highs by the end of the year. But in the recession scenario, they say equities, in this case, the S&P 500 could go down to 3,600. So what do you do with this information? You do nothing at all. Goldman Sachs has absolutely no clue what they're talking about. Because with the same mouth they said that they see stock downside even if the recession is avoided. So what about the 4,700 target by the end of the year? If the recession doesn't happen, we go down anyways. You see, this is what happens when you have this woke/hip management. And at Goldman Sachs, they said no more suits. You can come to the office and meet clients with your pajamas. Next thing you know, Goldman Sachs is selling hot dogs. And what about the macro front? No good news either. On Friday, we got the jobs report, and yes, the economy created, quote unquote, created over 400,000 jobs in, April. Whether you believe that number or not doesn't matter at all, because in any case, good news is bad news, because good news means that the Fed has to act even more aggressively. But the bad news for us, yes, wages are moving higher, 5.5%, but they're lagging the CPI, aka the CPI, at 8.5%. So net, your average American is losing about 3 points. Okay, this is the thriving economy that we're living in. And of course, the cooks are going to try to push that CPI down to 8.2 to say, hey, look at this, your wages are rising higher and inflation is peaking. But we know that the CPI does not reflect the true nature of inflation, because real inflation is at around 20% right now in this country, if not even more. And the consumer is not going to forget about that because the CPI says inflation is peaking. The consumer still has to pay insane rent, insane utilities, insane prices at the pump, insane prices at the grocery store, and they're not going to be able to spend and stimulate the economy in restaurants, in traveling, in buying goods, etc., etc. And the consumer is already in trouble, by the way, because they have to chase this inflation. If your wages are down 3 points, you got to make up for that. Well, how do you make up for that? By swiping those credit cards up and down, up and down, up and down. And look at this. U.S. consumer credit month over month, the highest in decades. So when they say, hey, this is this is not 2008, 2009, because the risk is limited. This is limited. Give me a break. And look at this. Inflation is out of control. Even Fox News interviewed DJ Pauly, and he said, this is insane, bro. Look at the prices of hair gel. Unbelievable. And this guy's what, 45? He has kids. He's pretending like he's 25. Anyways, speaking of pretending and changing the facts, what about your boy Joey B? Well, he's in a world of trouble, and he doesn't even realize that he's in a world of trouble. He doesn't even know that he's president right now. They have to constantly remind him. But he says our plans and policies have produced the strongest job creation economy in modern times. Oh, really? Look at that. Joey B's beating Trump, Obama, Bush, Clinton, the other Bush, Reagan, everybody combined, even Washington. Everybody loses to Joey B. Here's the reality. He did not create shit. All what the economy did is recovering all of these travel and leisure jobs that we lost from the Great Panic in 2020. And even today, we have more ground to make up. We're not back at the 152.5 million jobs that the economy used to have. But this is what happens from the Biden-Powell regime. Propaganda, brainwashing, weasel around the facts, never straight with the American people. And of course, the propaganda sometimes it works, at least in the short run. For example, the public expectations of inflation over the next year moderated in April because they continue to talk about peak inflation, peak inflation, peak inflation, peak inflation. And the cooks might give us a peak inflation reading. Stocks go up, everybody celebrates, and then we get hit the very next month once again. And therefore, I say this, the stock market has gotten oversold. We know that. The stock market is primed for a massive rebound rally because it will be combined with a lot of short covering, but it needs a catalyst. We thought that the catalyst was last week when Jerome Powell took the 75 basis points off the table. And immediately, the Nasdaq surged over 3% in a single day. Lots of short covering. And then came the commentary from the Bank of England, and that catalyst died just like that. Had the equities market rallied higher off Powell's comments, we would have said that May would have been a great month for equities with only one bump on the road, which is the CPI reading. But now that the rebound reversed and then some, on Wednesday, the next CPI reading becomes the only hope that the bulls have. That's it. Otherwise, there's nothing. There's no earnings. There's no macro data coming out besides the CPI. There are no Fed meetings for the remainder of this month. So it all comes down to the CPI. Either the CPI will initiate one of the biggest rebounds you'll ever see in the stock market, or it's going to initiate a massive flush down from this point on. What do you think will happen? You think the cooks will give us a peak inflation reading, or is inflation too bad that despite the cooking, they're not going to be able to hide it? Let me know in the comments. But for now, I gotta move on and cover the stock market for you, and we start with the market performance today, and here we go. The Dow Industrial Average down big, 653.67 points, or down, or about 2%. The Nasdaq down big, once again, 521.41 points, or a decline of 4.29%. S&P 500 down by 132.10 points, or a decline of 3.20%. The sector's performances down across the board, shame on all of them, and the losses were led by energy. This is highly critical. It's really important that energy stocks crashed altogether today. And I have a reason for you, but I doubt that it was the actual reason behind the selling, which makes it a little more sinister. We'll talk in a minute in the futures market coverage, but we also have cyclicals down big and then technology. All of these sectors are leading the losses today. The advanced decline ratios, NYSE a pathetic 11% advancing versus 86% declining. The Nasdaq 13% advancing versus 83% declining. Now look at this, 1,048 new 52-week lows on the Nasdaq. Unbelievable. We have not seen this number in a long time. Over 1,000 readings of a new 52-week lows on the Nasdaq. Wow. Commodities down across the board, a massacre across the board. So what's going on? Is inflation peaking? Is the economy already in a recession? What's going on here? Crude oil down big, over 6% across the board, WTI and Brent. And this is the piece of news that could have, keyword could have, impacted crude negatively. We know what's going on in China, the draconian lockdowns that don't make sense at all. But perhaps Chairman Xi has a sinister reason behind that. It could be the elections. I mean, what elections, right? The guy's president for life. But it could be an attempt to crush commodities. China happens to be the biggest consumer of commodities. If the prices go higher, the Chinese economy is harmed. We're already seeing commodities caving under Chinese pressure. Now, Saudi Arabia is cutting oil prices for buyers in Asia, including China. So the Saudis are now folding and saying, you know what? It is in our interest and OPEC's interest not to keep these prices higher for too long, because at some point it's going to fire back. Of course, the Saudis are concerned that the Chinese will take advantage of cheap Russian oil, and then the Saudis would lose their market share in China. So this could be, keyword could be, the reason behind the declines in crude. But it was a down day across the board. Gasoline was down a little over 2.75%. Heating oil down over 2.5%, and natural gas down big, over 12.5%. Nat gas topped at around 9, which we called for in this program when we covered the monthly chart, and perhaps the mystery trader who initiated the short squeeze in nat gas has already booked profits. We'll see. But for now, the tailwinds for nat gas to move higher remain intact. Look at the exports of LNG, through the roof. We're exporting more natural gas than ever, specifically to the European Union. And watch out here, because we're taking supplies from the domestic consumption, or we're sending that all the way to European countries to substitute for Russian gas. At some point, the American consumer is going to catch up to that and say, hey, wait a minute here. You're sending my gas over to Europe? Meanwhile, we have a shortage here, and I'm paying more for gas, and this is going to be a major political problem. And therefore, I continue to say, for the administration, what is the end goal in Ukraine? What is the end goal, not just for the war, but also for the sanctions against Russia? Because we're not going to be able to cancel Russia for a long period of time. Certainly, the Europeans are going to fall apart. The economies are going to fall apart without Russian supplies. We cannot substitute Russian supplies entirely, in this case gas, until 2026. What's going to happen between now and then? Anyhow, when we talk about softs, down across the board, cocoa down, cotton down, OJ down, coffee, lumber, sugar, all down. We're talking big time, over 2% in certain cases. Metals, down across the board, gold down, silver down, platinum down, copper down. The only exception is palladium. Palladium is up almost 2%, but palladium has been hit hard in the last few weeks. Meats, modest gains for live cattle futures and modest declines for feeder cattle futures. On the other hand, it is a slaughterhouse for lean hogs. Lean hogs is down almost 2.75%. Grains down across the board. Soybeans, soybean oil, corn, wheat, canola, doesn't matter, all down big. Is this the beginning of the crash in commodities? Who knows, because the tailwinds remain intact. For example, we have a massive shortage of wheat and corn due to the war in Ukraine and the sanctions against Russia. Somebody got to substitute those lost supplies of wheat and corn from Ukraine, and Russia for that matter, because the ships are now moving out of ports. Everybody's afraid of the sanctions. Who's going to substitute the supplies? You got the US, you got Canada, and you got India and China. We know China is not going to do anything at all because the domestic market, the food security comes first with China. Canada is not able to produce wheat, at least not this season. Likewise, U.S. farmers cannot ramp up the supply of corn and wheat due to the shortage of fertilizers. And look at these prices of fertilizers, by the way, to the moon. So that leaves India as the only country available to substitute the lost supplies of wheat and corn, well, wheat in this case, not corn, from Ukraine. Here's the problem. India has domestic problems too. Either they're going to feed the world or they're going to feed their own population. But here's another problem. Recently, we got a massive heat wave over India, which now we're hearing that perhaps the wheat crop will be down 50% due to the heat wave. Unbelievable. You cannot even make this up. This is what really concerns me about this inflation. Food inflation. Who's going to feed the angry populations in Sri Lanka, in Thailand, in Egypt, in other countries? What are they going to do with that food? I tell you what, they're going to have riots, revolutions, uprisings, political chaos, perhaps civil wars. And this is the danger from this food inflation and the scarcity of food. Moving on to the big casino, the options market, what's going on here? The volume remains way too low. They're buying more puts now. Nobody wants to buy calls. Well, if nobody's buying calls, no rebound will be sustained, and the stock market is not going to find any bottom. For this market to bottom, we need to see a lot of call options buying. We need to see the volume moving significantly higher. This is not the case, at least for now. Regardless, Apple came at number one at around 1 million contracts. About 48% of those were calls. They're buying more puts now. It could be a contrarian indicator that we're near a bottom. But until we see a huge surge in volume and lots of call options buying, you cannot say it is the bottom for sure. At number 2, Tesla, the souffle, at around 550,000 contracts. About 48% of those were calls. At number 3, AMD, at around 420,000 contracts. About 60% of those were calls. Here are the unusual activities that took place in the options market today. We start with the ticker AAPL, Apple. Now, I shared some information with you last week that some of my clients dumped Apple entirely. And I said, folks, do you want to buy put options as insurance? They said, no, we're done. Dump it. We're done. But here we have somebody perhaps buying insurance on Apple, or maybe betting against the name. In this case, they bought the 140 puts for the expiration date, June 17th, with the expectations that Apple could go down by more than 8% by then. They paid around $3.50 a piece to enter this trade, all in all spending around $11 million. What about the ticker BAC, Bank of America? They're buying calls, the $40 calls for the expiration date, June 17, with expectations that BAC could move higher by more than 10% by then. They paid around 55 cents a piece to enter this trade, all in all spending around $1.1 million. What about the ticker AMD for, you guessed it, AMD? They're buying calls, the 100 calls for the expiration date, May 20, with expectations that AMD could move higher by more than 16% by then. They paid around 70 cents a piece to enter this trade, all in all, spending around $1 million. What about the ticker FUTU? I'm not cursing at you. This is for Futu. The name is a disaster, and somebody's bidding for more pain to come. They're buying the 25 puts for the expiration date, June 17, with expectations that the name could go down by more than 12% by then. They paid around $2.60 a piece to enter this trade, all in all, spending around $2.5 million. What about the ticker F for Ford? Ford was one of the top performers in my portfolio last year. Not anymore. It is actually one of the worst performers, and somebody's bidding for more pain to come in Ford. They're buying the $12 puts for the expiration date, June 17, with expectations that the name could move down by more than 10% by then. They paid around 45 cents a piece to enter this trade, all in all spending around $400,000. And lastly, at the bottom of the table, what about the ticker AAL, American Airlines, a name that I'm shorting, but so far the consensus seems to be the reopening. The reopening will happen and people will fly again, and therefore you're going to buy airlines. I disagree, and somebody agrees with me here. They're buying the $15 puts for the expiration date, May 20th, with expectations that the name could go down by more than 8% by then. They paid around 45 cents a piece to enter this trade, all in all spending around around $400,000. Moving on to the heat map, what's going on here? A bloodbath across the board, with the exception of defensives. But even the cyclicals, the inflationary names in materials, for example, agricultural names, energy down big. So what's going on here? Is it an exodus from everything right now? Is it a sign that a crash is coming? Or is it a sign of capitulation, meaning a bottom is coming? That remains to be seen. But if there is a bottom coming, we know the catalyst. The catalyst would be the CPI reading. So for now, we have to assume that this is a panic for market participants expecting a crash, booking whatever profits they can find, including energy. And Wednesday will be the day of judgment. Either the crash is going to happen, or we're going to see a massive marking of a bottom and a rebound from that point on. But for now, what's working within defensives, by the way? Now, if you listen to the previous video that I produced today, I talked about in defensives, you want to be with food, packaged food. We're talking about General Mills, the ticker GIS. We're talking about Kraft Heinz. We're talking about Kellogg's. We're talking about Campbell's Soup. These names are going to tend to outperform. But even the Coca-Colas of the world and Mondelez, for example, these are going to hold a lot better, but the international exposure is also going to weaken these names. You're not going to find the perfect pick, but do your own research. Look at the fundamentals. Look at the dividend yields, for example. Look at the technicals. We will cover some of these charts in tonight's program and make your decision which one you want to be in. But for now, this is the only corner that is working in the stock market, at least today. Now, I got some news for you, corporate news. Let's talk about Palantir, because Palantir is among the retail crowd favorite names, and it's down big today. It's below the IPO price right now. We're going to cover the chart of Palantir in the charts analysis. But the point being is, remember all the pumpers, the fake YouTubers, Palantir to the moon, yada, yada, yada. Meanwhile, the CEO of the company, Alex Karp, has been dumping more than anything I've seen before. You think that guy believes in his own company? Of course not. You think that guy thought the valuation last year made sense at all? Of course not. But they say, oh, this is just scheduled selling, yada, yada, yada. And the cult, the morons in the retail crowd say, oh, he has to sell. I mean, he needs to raise cash run through the wall. Meanwhile, now you're holding a back. A big one, perhaps one of the biggest. So how do you feel now? Where are the pumpers, by the way, the Palantir pumpers? Are they still here? Let me know in the comments. Here's another company, the ticker AGCO, AGCO, performer for the year, a good performer, but they're dumping Deere, now they're dumping this name too. And it got hit with a ransomware. And the interesting fact here is this attack connected to Russia? Because we've noticed a theme in the war in Ukraine where the Russians are stealing Deere tractors for some reason. Like, that's the jackpot for the Russians. Why? Are they running low in Deere tractors? I don't know. And is this ransomware attack connected at all? I don't know. But it sounds like it. It sounds that Russia is running low on tractors. So they have to steal them and figure out a way to get them, because these companies are now boycotting Russia. They got their own suppliers, but they're not as good as these two companies, Deere and AGCO. We're also seeing the Chinese stocks crashing across the board, and now we have concerns that companies like NIO, one of the retail crowd favorite names, would be delisted. So watch out here. And then we have criminal gangster JP Morgan Chase CEO Jamie Dimon from the Landromat. Well, he's asking for a fat package. He wants to get paid. He didn't wash all that money for free. But the shareholders are voting against the package. We'll see what happens. And here it is, the last piece of corporate news. The evil empire of Amazon is now firing the senior managers from the recently unionized Staten Island warehouse. What does that mean? I mean, is this America, by the way? Or is this an oligarchy, a banana republic, where you can bully workers? I mean, the most American thing you can do is unionizing for labor, to organize, ask for better wages, better benefits. This is the most American thing that can happen. But no, the evil empire says, watch out here. If you unionize, we're going to crush you. This is a warning, an intimidation tactic to other warehouses, that if you unionize, we will fire your ass. Who's going to confront this bullying from your beloved politicians, by the way? The answer is none. You know why? Because they're all in the pockets of Amazon. This is how the oligarchy works. Anyhow, moving on to the heat map for the ETFs. Bloodbath across the board. No exception here. Everything is down, with exceptions of the inverse indices, VIX proxies, and that's about it. But the interesting finding is, why is the XHB, the Home Builders Index, down modestly? I know it's down big year to date, perhaps it is oversold, I know that. But could this be a leading indicator that the 10-year yield is about to go down and hence home builders are about to rebound? We'll see. Moving on to the charts analysis, and I have a lot of charts here, more than 30. We'll see how much I'm going to cover, but we start with SPY, the S&P 500 30 minutes chart. My analysis says that after 410.5, the next support is 405. And that was broken today. So there is no other support to look forward to. And therefore, we're seeing everything falling apart in a big way. The gravity is showing up right now. There is no point in identifying support at this point in this chart because it's a free fall until and unless we get a reversal pattern. Are we going to get a reversal pattern, let's say tomorrow? Maybe, but most likely it's going to happen on Wednesday if the cooks come out with a peak inflation reading. At what point, at what number will the SPY rebound from? We have no clue, but there are important numbers on the daily charts, so let's do that. We start with the continuous contract for the SPY, a daily chart. The most important number is 3,960, and it appears that we're already there. If that doesn't hold, then good night, Irene. It's going to be a massive flush down. Now, look at the momentum indicators. They're curling down, but most importantly, the MACD. It was about to cross, producing green impressions on the histogram last Wednesday after the FOMC, but then it failed to cross and it moved down again. Now, this is always an ominous sign in any chart, and therefore we're seeing this massive flush down. The moment 4,102 was lost, here comes the cascading impact all the way down to now 3,960. When we look at the cash index, the SPX, let's hear what I said a few weeks ago and then come back. What about the SPX? The cash index, not a good look, lost the 200 days moving average for good. We have a negative divergence on the RSI and the MACD indicators, and the volume is rising higher on down days. Could the chart rebound higher from a reverse head and shoulder formation, let's say at around 4,300? It is possible, but the consensus for now is for the SPX to go down to 4,000, retest that as support, and then we could see a lot of institutional buying if we see a rebound from 4,000, but most importantly, we see the fundamentals changing, be it inflation cooling down, be it the Fed not having to be too aggressive, for example. From a technical standpoint alone, you wait for the reverse head and shoulder. If that doesn't happen, then 4,000 will be the next stop. And here it is. We're already at 4,000 now. 4,000 is the important psychological number. The algos are looking for it. The retail crowd is looking for it. The institutionals are looking for it. Everybody's looking for it. If this number fails to provide support, then all bets are off. We could see a massive flush down because the volume is moving higher on down days, big time. The bulls better hope that 4,000 is going to hold. Here's the Q's 30 minutes chart. We lost 313. After that, we have 297.5. We stopped exactly at that. You can zoom out in the Q's chart and figure out why 297.5 is critical support. Can we rebound from this point on? Yes, the charts are getting oversold. But what is the catalyst for the rebound? I don't see, besides the CPI, I don't see anything else. Here's the daily chart for the continuous contract for the NASDAQ. Again, the volume is moving higher on down days. Bad sign for the bulls, good sign for the bears. On top of that, the momentum indicators, look at the MACD. It was about to cross and it failed. It went down again. This is one of the most ominous technical signs you can find. And we saw that back in the crash of 2020. We're now looking down at 12,000.27 as support. If that doesn't hold out, then I don't see a lot of support below this number. And here's the ominous thing from a technical standpoint that happened in the NASDAQ. Take a listen to what I said just a few weeks ago. When we zoom out to a weekly chart and we clean it up a little bit, leaving the trend line of support, look at that. If that line is broken, oh boy, we could see a massive flush down, the likes of the crash of '09. So the bulls better hope for a rebound at this point. The problem is, what if this is an ABC pattern and we're about to break that trend line and go even further down? This is what the bears are betting for. And here it is. The ABC pattern is playing out. The NASDAQ lost support. This is not a good sign. Can you get rebounds and a retracement to the same trend line? Yes, but in all likelihood, it's going to fail in attempting to reclimb the trend line. This is not a good chart to look at. It's going to get oversold at some point. We're going to get a rebound, but these rebounds are not going to last. And if this momentum to the downside continues and we see more margin calls, by the fourth quarter of this year, we could be down to the pandemic lows. Watch out here. Here's the IWM 30 minutes chart for the Russell 2000. There's absolutely nothing to look at here. The momentum indicators are awful, and we lost the last support of 188. So we have to zoom out to the daily chart, and it's a mess because I have all my notes from the 30 minutes chart. But regardless, you're big boys and girls, you can handle this. The next support is filling the gap at around 164.91, which will be a downside of yet another 5.7% before we get there. Here's the Dixie, the dollar index, daily chart. No stop in sight here, and of course the only headwind for the dollar is the upcoming CPI. The cooks have a big job to do here. Otherwise, if the dollar continues to move higher past 104, 105, you're going to see stocks crashing either way. And by the way, commodities are not going to be spared from that crash. Here's gold. Gold is moving down now because the dollar is not giving up at all. The 10-year yield is not giving up at all. So we have to wait for the CPI. If the CPI comes out with a peak inflation reading, we could see gold moving higher again. And of course, there are folks who say, but that doesn't make sense at all. Gold moves higher when inflation moves higher. Not really. That was the case back in the 70s, not the case right now. Why? That's a topic for another video. We don't have time right now. Here's the Henry Hub futures for natural gas. Again, I pointed out that the resistance could be at around 9. This is exactly what we got. 9 was the top for now, and nat gas went down big since then. Now we have a center of gravity in the trend line in yellow, acting both as support and resistance. This is a daily chart, by the way. And the question is, will natural gas go down all the way to the trend line and then catch support from that point on? Or the natural gas bulls would argue that this is a channel for now. We have higher highs and higher lows. If that holds, we will see natural gas rebounding from this point on. Of course, if the larger trend line is broken, you know that the momentum in natural gas is gone. Here's a crude oil 4 hours chart for Brent. It faced the soft resistance at around 114. It did not make it above that, and now we're seeing a flush down all the way to the support of 105.84. If this number doesn't hold and produce a rebound, then we're going down to 100. Here's the daily chart for the 10-year yield. Again, we got a down day on Friday, another down day today. But can you say that this is a confirmation that this is the top for now? Of course not, because we have to wait for a fundamental reason behind the top in the 10-year yield. We only have the CPI. Either the CPI delivers or not. And of course, the TLT bugs. Here's a weekly chart. They're on pins and needles waiting for the CPI reading. A peak inflation reading will push the 10-year yield down. The TLT would explode higher in a short covering rally that you haven't seen in a long time. Now, can you bet on it? It depends. Do you got brass balls or not? Because brass balls could cost you a lot of money too. Or do you wait for the CPI to come out and then reassess, and you're going to have plenty of meat in the bone if the move happens. Here's the VIX 4 hours chart. Again, the head and shoulder formation is not happening, and the VIX managed to reclimb the trend line, making higher lows once again. So if this pattern holds, then we have another higher high coming for the VIX. The next target will be 38. The MACD is showing green impressions on the histogram, indicating positive momentum. The RSI is moving higher again, reversing the negative divergence. We haven't seen the top in the VIX yet. It should have moved a lot higher considering the losses that we got in the indices. So the lagging reaction, the divergences are highly interesting. It's one of two things. Either the VIX is predicting that whatever sell-off that we're having in the indices is overdone, or the VIX has yet to catch up with what's going on in the stock market, meaning the VIX could explode even higher. It's one of two things. We'll know when we know. Here's the VXN, the VIX for the NASDAQ 4 hours chart. Once again, we had a triple top. This triple top was broken again. This is a sign of strength, not weakness. And now we have 40 as support. The next resistance will be around 44.5. The MACD is showing green impressions on the histogram once again. The RSI is moving higher, reversing negative divergence. All of these are indicators that we will see another pop higher in the VXN, and perhaps another flush down in the Qs until the CPI either comes with a rescue or not. Here's Apple, a daily chart. Oh boy, it's now down at the support of 150 and the lower edge of the trading channel. After that, it's going to get really ugly. The resistance remains at 157. We'll see if Apple can rebound higher or not. If it breaks 150, we're going to see a flush down in Apple. If Apple flushes down, so will the NASDAQ and the SPY. Here's Tesla from a 30 minutes chart, it lost the supports of 825.25. It also lost the support of 802.41. So we have to zoom out to the daily chart and see what's going on here. Well, the next support that we have is around 756.5. That is another 4% or so to the downside, and then we'll take it from there. What about tulips? Bitcoin, look at this, a flush down. We lost 35,750. We almost lost 30,000 today. It remains support for now at the time of the recording of this video. But if the CPI doesn't rebound, then Bitcoin will lose 30,000. If Bitcoin loses 30,000, guess which stock is going to crash entirely? Here's a clue. Here's another one for the ticker MSTR for MicroStrategy. This is pretty much a proxy for Bitcoin because drunk Michael Saylor continues to buy Bitcoin like crazy. And just a spoiler alert for you, do yourself a favor and look at the monthly chart for MicroStrategy and look at what happened back in the dot-com bubble. Just a little hint for you. For now, we have a massive bear flag. Although this is the weekly chart, on the daily, it is catching support from that trend line. We could see a pop hand to hand with cryptos rallying higher from oversold conditions, of course. Yet the problem remains that this is a weaker chart. Even though Bitcoin had ups and downs, this chart really since the peak hasn't been catching a bid whatsoever. So this name remains weak. You don't want to touch it here. You can play the oversold bounces, but be careful with this one. And since then, MicroStrategy is down big. And remember, drunk Michael Saylor said if Bitcoin goes below 20,000, he's going to get hit with margin calls and MicroStrategy might go down. And it will go down. Make no mistake about it. Here's Palantir, a weekly chart. Again, you have the center of gravity, the trend line in yellow, acting both as support and resistance. Of course, there was a trading range, 17 as support and let's say 27.5 as resistance. The chart broke into support, not a good sign, and now we have this sloping line. We'll see if it's going to hold as support or not. We're close. If that doesn't hold, then boy, this is going to flush down big, and it is a recent IPO, so you're not going to have a lot of technical indicators to guide you here. Next, let's follow up on certain trades that I conducted recently. CMG, Chipotle, let's see what I said before. Here it is. Next, we have Chipotle CMG. Now, I cannot short this name because it will cost me at least $7 million, but I can buy put options on it. Here's the weekly chart. We have a bear flag pattern, and we have relative weakness in the MACD and the RSI indicators. Perhaps the great run of Chipotle is coming to an end? We'll see. And if it does, when we use the Fibonacci levels, the next drop in the stock could take us down all the way, about 18% to the downside, and the support will be at around 1,183.5. And here's the update. Chipotle is down, but it has yet to go down all the way to, let's say, 183.5. So if you bought put options, it is up to you to decide whether to book profits or not. I always say in this market, always be closing. But if you have longer expiration dates, you can hold on this one for a little while, meaning you can close half of the position and then let half ride in case if we have lower lows for CMG. And then I tweeted this last week. I said, as interest rates rise, consumers will shift their spending behavior. One of the casualties of this shift is leisure and hospitality sector. Therefore, I placed a short position on Live Nation last week, and today I added Hilton to my short portfolio. So let's take a look at these charts. We start with HLT Hilton. This is a weekly chart. Again, you have a trend line. The trend line was broken for good, and then you have a gap at around 92.84. The assumption is you're going to see this chart flushing down all the way, closing the gap. Now, you look at this chart, and it is a reminder, if you watch the previous video, of charts like Shopify and Etsy before the crash. So if you missed on Etsy and Shopify, the leisure sector is providing you with shorting opportunities, because what happened to Etsy and Shopify will also happen to the hotels, casinos, the cruises, the airlines. All of these names are going down because the economy will hit a recession. Now, let's go back and hear what I said about LIV, Live Nation, and come back. Let's start with the ticker LYV. This is for Live Nation, a weekly chart. I shorted the name last week, and I'm talking about a long-term short, not via put options, an actual short of this name. If the economy is about to slow down, or we're going to see the consumer adjusting their behavior, then spending thousands of dollars in concerts and entertainment is not the way to go for the consumer. And therefore, the financials for this company will start to get hit. Now, the stock market is a mechanism that looks forward, meaning right now we're seeing consumer spending in concerts and entertainment venues hot, hot, hot. But 6 months from now, the picture will look drastically different. And therefore, we have a trend line, we have a saucer top, we have negative divergences on both the RSI and the MACD. Yes, the stock could rebound from a daily chart perspective, but in the long run, it's going to lose the support. And in my opinion, the chart will lose half of its value all the way down to 60. And here's the update. Since the break, it went down by over 20%. We have negative divergences in both the RSI and MACD indicators. Now, I have a core short position in this one, not via put options. I actually borrowed the shares, so I'm going to continue to hold on this one. But if you bought put options, again, always be closing. You might want to let about 10% of the position. You might want to let that ride in case we see a crash in this name, and it happens in a timely manner. Now, we have a few winners that perhaps you want to pick up as a long idea. One of them is McCormick. Let's go back and hear what I said about this name just a few months ago. And here is the last chart of the day for MKC McCormick. We talked about this stock a little bit in the beginning of this video, but here's the chart. A weekly chart, we have a descending line, a sloping line of resistance, and it was broken higher. On top of that, we have a fundamental story here, with spices prices moving higher due to inflation. They have the pricing power. They're going to jack prices higher beyond what they need to cover the input cost inflation. Now, I have a few profit-taking targets which happen to be resistance lines. Line number 1 happens to be 95.89. Line number 2 happens to be 98.80. But the stock can continue to run higher all the way to these levels. We have a lot of profits to capture here. And here it is. Since then, the name is up big, double digits, and it is consolidating for now. Is this a buying opportunity? Well, for now, perhaps it is, because the staples, the consumer defensives, they're still working for now. So if we're going to see a rotation of cash, perhaps McCormick could be a name that could catch a bid. So keep an eye on this name. I'm not saying buy, I'm not saying short, I'm just saying keep an eye on this name. If it breaks the consolidation higher, then you have your signal to buy the stock. If it breaks the consolidation to the downside, then no harm done. You did not commit capital to buy the name. Here's another trade that I discussed last year for the ticker OC Owens Corning. Let's look back and hear what I said. Lastly, I want to talk about this chart that I bought via call options. And of course, I'm doing so with the intention of converting the position into stock, but I'm buying via options to hedge my risk in case I'm wrong. And the ticker is OC for Owens Corning. Why are we buying this stock? Think about it. Let's say interest rates go down due to fears of an upcoming recession. This will be good for the housing market because mortgage rates will plummet down. You're seeing the demand of lumber also moving higher, and therefore housing supplies and housing contractors will also, the demand for them will also move higher. A riskier bet will be buying home builders, the likes of Toll Brothers, D.R. Horton, Lennar. Yes, they will be beneficiary, but you cannot guarantee the price fluctuations in the housing market and how that will impact their bottom line. But sticking to the bullet stocks in the housing market will work. And the reason is whether the 10-year yield moves higher or down, whether we have a recession or not, these contracts are already locked in. To begin with, the country is already short about 5 million homes. These houses will be constructed, the demand will remain high, and the shortage of supply is still here, meaning supply will come to the market, even if it does gradually. On top of that, we have at least 29% of for sale homes not under construction yet, meaning they're going to sell these homes and they have to be constructed either way. The home builders could get hit via price fluctuations, but the suppliers of building materials, A, they have the pricing power. B, they're locked into these contracts. They're going to get paid either way. If we have a surge in demand for homes, these suppliers will benefit tremendously. A company like OC Owens Corning, which produces insulation for homes, they command the pricing power. The home builders will have to buy from them anyways. They will pay more. The demand is still high. The supply is way short for homes. A safer bet on the housing market right now is to buy these suppliers. When we look at the chart for the name OC, we have a descending line. This is a weekly chart, of course. There was one attempt to break above the line. That failed right away. Now we have another attempt, and it appears so far to be successful, at least for now. And therefore, I'm buying via call options, not buying the stock right away. Now, you have to bear in mind, since I bought the call options and I bought them in the money, the stock moved higher aggressively, and therefore we could hit a resistance soon on the daily. The chart could be overbought soon enough on the daily because we have resistance at around 98. But my thinking is, I bought the calls at 90 with the expiration date in January. If the stock moves higher, and closes above 100 by the expiration date, then I have a lot of cushion here, $10 worth of cushion, and I will comfortably exercise my options to own the stock. Just an idea to think about. Now, what didn't happen is yields went higher, they did not go down. So this is a massive headwind for housing. And the reason is mortgage rates are moving higher, so you would think that all of these housing-related stocks will crash. Not this one. The home builders went down. This name continues to consolidate. Yes, it is disappointing that the name did not blast higher, but consolidation for now is a lot better than what's going on in the rest of the market because look at the contrast between OC in orange and XHB, the home builders ETF, in blue. Year to date, the XHB is down over 27%. OC Owens Corning is pretty much flat. Matter of fact, it is up about 1.7%. So yes, I'd rather be in OC than the home builders because the home builders are going to eat a massive bag. On the other hand, stocks for piping, roofing, carpenting, all of these stocks are going to continue to fare a lot better than the home builders. Now, here are a few bullish charts. We start with the ticker GIS, General Mills. It is on a positive trend. This is a weekly chart, and it's now facing the resistance from 2016 at around 73. If the name breaks above 73, likelihood is we will see a pullback to 73. That would be a rebound and then a move higher again. So keep an eye on this chart. Another one is Kraft Heinz, the ticker KHC. Again, it is moving slowly but surely higher, and it wants to close the gap on the top of the flush down candle at around 48. Now that would be a gain of almost 8.5% from this point on. So again, keep an eye on Kraft Heinz. Another one is the ticker SJM for Smucker. This is a monthly chart. Again, a defensive name, a food-related name. We're seeing the saucer formation, which should get us all the way to the previous highs at around 154.5. That would be a gain of about 6.5% from this point on. And lastly, I want to talk about certain Japanese stocks because I said that the devaluation of the yen will be pretty good for multinational corporations from Japan. So look at names like Komatsu, for example. We have a trend line, then we have consolidation for a little while. Is the consolidation being broken to the upside? If it is, then this is an opportunity to buy. Another name is Sumitomo. This is a monthly chart, and as you can see, the chart wants to go all the way to all-time highs from 2007. So we have a destruction in US and European equities, but certain Japanese companies are still in a bullish trend. They're moving higher in a significant way, and the reason is the yen is down and the Bank of Japan continues to ease. Here's another one, Mitsubishi. Now, perhaps you want to wait in this one because this is a weekly chart. We have negative divergences on both the RSI and the MACD. We also have a bear flag pattern. It could take the chart all the way down to the trend line in yellow, and then it could rebound higher. Here's another one that I like for Tokyo Gas. We have and this is a weekly chart, by the way. We have a reverse head and shoulder pattern. We have a sloping line of resistance. The name broke the resistance, and now it is melting up higher. So this is a lot of momentum. It's going to take us all the way to the previous high, and then we will see consolidation. So more gains to squeeze here, but perhaps you want to hop in after the pullback. And lastly, moving on to the conclusion of this video. What do we have on the economic calendar? We have the Small Business Index, and then we have real household debt. With that, folks, hope you enjoyed the video. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.
I know exactly how it ends.
So what?